What's going on, everyone? This is
Yes.
Jay Wicker with Real Estate Aholics, and we got some great topics going on today. But before we get to those topics, man, I'll get to that topic, that note buying. We got a couple of great entrepreneurs on here, co-hosts. Starting from Mr. Cody. Tell me where
Hey,
you
hey.
logging in from, what do you do, all that good stuff.
Well, thank you very much, Jan. It's always a pleasure to be part of this group here. So I'm Cody Cox. A CEO of a company called Bridge City Factors. We actually are a note business. Bridge City Factors itself is a management company that manages note funds. And we have a partner note fund called BCF Fund One, where we actually raise some capital. It's a Regulation C 506B fund where we've raised some capital from investors. We use that capital to purchase notes and place them in our inventory. And then the payments that come in from our borrowers on this, we pay back the investors that are part of the fund. So it's a little different than I like to strike a difference, and we'll probably get into this a little deeper, between running a note business like I do versus note investing, which I also do, but they're two separate things, although they have a lot of similarities in what they do. I'm out of the Northwest. I'm headquartered just south of Portland, Oregon, but I'm doing some business travel. I'm actually heading to a conference that starts tomorrow evening in Nashville that is called Diversified Mortgage Expo, which is all about note investing. And there's about 350 of us that are coming together for a 2.5 day conference. And I'm honored to get to moderate a panel on Friday morning. So I'm excited about that as well.
All right.
So you're the
Congrats.
moderator, huh?
Yeah, I'm
That's
one of
pretty
the
cool.
panels. I get to do that. Yeah.
Oh, excellent, excellent. Oh man, that's pretty cute. That's pretty cute. And you said how many people?
There'll be about 300, 350 people there. So
Oh wow. Okay. Absolutely, man. Keep rocking. What's up, Lenny? Uh,
Can't hear you,
uh,
Lenny. You on mute.
Oh, there we go. There we
There
go. Hey,
you go.
man, what is going on?
What's going on, man?
not much, not much. So, Jay, go ahead and jump in right quick. Tell us where you're logging in from. What do you do? All that good stuff.
All right. Well, this is Jarrell coming out of Atlanta. I am a hard money broker, funding real estate from fix and flips, buying commercial property and multifamily properties. If you looking for a loan, getting 90% of purchase price on your fix and flips, I'm your guy. Looking for 80% refinances, I'm your guy. Just hit me up at bpiquickloans at gmail.com.
Excellent, excellent. Lenny, right on time, man. Tell us
Most
where
definitely.
you logging in from. What do you do? All that good stuff.
What up, guys? My name is Lenny, man. I'm the host of Wholesale with Lenny. Also the admin of the Creative Financing with Lenny Group over on Facebook. I'm a buy and hold investor. I use wholesaling real estate towards my pretty much to buy my real estate. Also use creative uh, finance methods to buy real estate, man. And if anybody's ever looking for some help, man, hit me up.
Absolutely, absolutely, man. So these are the investors here, man. This real estate hall, guys. So look, man, we got some a great topic, man. We're gonna touch on, man. So look forward to hearing you guys' comments on these things on these things we're gonna talk about today. So today, man, we're talking about buying mortgage notes. I've heard about this forever, right? Never thought about getting into this aspect of real estate. But after me doing my due diligence, man, I think it's pretty cool. It's pretty cool. And we're gonna dive right into this thing, man, to show you guys how cool it really is. So the first question we're gonna jump out at is what is a mortgage note? What is that, man? So a mortgage note is a legal recorded for a buyer promissory pay loan. That's what a mortgage note is. So technically, man, a mortgage note, man. I mean, a note is something that we probably all have had to a greater or lesser extent. Maybe not a mortgage note if we never purchased a property, but if you purchased a car, you deal with notes, a promise to repay, right? So it's kind of the same thing. Would you guys say that?
Yeah, most definitely. I mean, that goes back to me saying, when I buy my real estate creatively, whenever I buy my real estate creatively, we always create a note,
Yeah,
right? So we always
yeah.
create a note whenever we do a seller carry, So definitely, man, I love it.
Yeah. Yeah. No, definitely. So where does that need to be recorded when we're dealing with real estate?
So, Jay, there's actually two documents that are involved in that if we're talking real estate. One is the promissory note that we've talked about here. And of course, that is the borrower's signed obligation to repay back, to pay on the mortgage itself. And so that's the document says I'm going to pay this loan. It also sets all the terms, what the length of the loan is, what the interest rate is, what the monthly payment is, if it's going to be a fixed rate loan, if it's going to have some adjustable capabilities of it. Is there a balloon payment on it? Are you going to make payments like it's a 30-year loan, but then it balloons after 10 years? And so those things are all spelled out in the promissory note, which is a promise to repay. But the associated document with that is either, depending on the state, a mortgage or a deed of trust. And so the mortgage or the deed of trust is a document that says that if you do not make your monthly payment, the lender has the right to foreclose on the property and take back the property as the collateral for the note. So that's really kind of the two main documents that are involved in a real estate transaction. And again, there's difference between whether it's a mortgage in certain states or whether it's a deed of trust. Most of us out on the West Coast use a deed of trust. And the primary difference in a deed of trust versus a mortgage is that a deed of trust allows us to foreclose on the property without going to court. It has what's called it please it says in it that we can do what's called a power of sale and advertise for 4 to 6 weeks, depending on the state guidelines, in the public newspaper of record, and then execute what's called a non-judicial foreclosure. So that means you don't have to go to court. But in the states that have a actual mortgage, which is kind of the generic term of all this, the mortgage does not have that power of sale clause, so you have to go to court in order to foreclose on a property.
Wow. So you have a deed of trust.
Yeah.
You have a mortgage note.
Yeah, or what we call a promissory note. Yeah, because that's a promise to repay, and that's supplemented by the mortgage or the deed of trust. Yeah, so those two documents are really, when you're buying a note, you're actually buying a file. You're buying a file that contains what we call a collateral file. And the collateral file typically is the original note, promissory note, the original deed of trust. Obviously, the deed of trust is the document that gets recorded with the respective county. Then you have what's called an assignment of deed of trust. So whoever owns that deed of trust is going to assign that over to my company. And then they also do an endorsement to the note, which can be called an endorsement. Yeah, very good. Good job. See, there's a deed of trust there that Lenny's showing up. So they're going to assign that note over to us and endorse it over to us in the form of endorsement. In a couple different fashions you can do that. So yeah, absolutely.
Blow that up again, Jack, Lenny. Hey, Lenny, let's see that again, Lenny. You might want to white out the stuff you got on there, though. Yes, sir. Yes, sir. Okay. So I think that's interesting, man. So there's two instruments that's in play here, right?
Yeah.
So one is the person who actually owns the debt. Another person who actually who don't in that situation, right? So it's doing a contract for deed. You're doing so the mortgage note is where. Oh, let me make sure I'm saying this right. So the mortgage note is the person who owns the debt, right? In that situation,
that's the person who owes the money to the lender. Correct.
Owns the money to the lender. Correct.
Yeah.
And the contract for deed. Okay. That makes sense.
Yeah. Contract for deed is a different animal. It's a different subject. Because in a contract for deed, the owner of the property is selling it to a buyer on a land contract, but is retaining the title. And so
Exactly.
they have a
Okay.
contractual interest in the property, but the title is still held by the original lender. And oftentimes that's an instrument gets used when there's maybe a private sale or a seller finance deal, those kind of situations. And so they're a little different animal, and they require a little bit different a process or due diligence if you want to purchase the land contract or contract for deed versus purchase the promissory note.
Okay. Okay.
Okay.
So go ahead. Somebody say something?
No.
One of my questions. Go ahead, Lenny. Was that you saying something?
Well, no, I was just agreeing with Cody.
Okay. So one of my questions is in this situation. So how do you do your due diligence on a note though? Like, where do you get that information from? I guess it'd be from a bank in that situation, right?
It depends on who the seller is. And I buy loans, in fact, my model is a little bit different in which I buy existing institutionally originated mortgages or deed of trust, promissory notes secured by real estate. And so and typically they come to me with a whole list of notes that they're trying to sell, which we call a tape. And so I will try and choose out of that tape based on the information that note seller puts in the tape, such as the address, what they're looking for, what the unpaid principal balance is, what the arrearage are, what the interest rate is, and if I can determine what they think the value is. And so I go through a preliminary due diligence to see, is this a note that meets my general model? And mostly what I'm looking at is this going to provide me a return if I pay X number of dollars for this? And so if I submit to them what we call an indicative bid and they accept my bid, then I proceed into a full-fledged due diligence. And so I ask for them to send me all the information in their file. That's the collateral file, their payment history, any sort of borrower notes. And hopefully that loan has been serviced by a licensed loan servicer. And then I have some other type of documents that I order. I'll do what's called it's called ownership and encumbrance report, an O&E, which basically is a title review over the last several years. And I also do what's called a BPO, broker price opinion. That tells me what they think the value is. And so with all those documents, I go through a process of doing some due diligence to make sure that my indicative bid is at a proper level based on the quality of that house, the quality of the paper that I'm looking to buy, and the completeness of the collateral package. Because really all I'm buying is a file like Lenny just pulled up there. He's got a file of documents in there. And when you're buying a note, that's what you buy. You're not buying the real estate. You're buying the paper that secures that piece of real estate.
Man, that's a cold game there, man. It's funny, man, that you first get in this game, right? You don't really hear about buying notes, right? The first thing you hear about is wholesaling or whatever the case is, right? So this is that next level. This is that next level. This is that behind the scenes.
Yeah, the first thing you hear about how to grab a check. That's the first thing you usually hear about.
Exactly. Exactly.
Now, when you get into notes, now you're talking about generating wealth.
Yeah. I mean, when I learned to, man, you can get it fast and you can get it slow too. So I know a lot of times what they call it recapitalization or whatever the case is, there's some ways that you can come up off the notes partially or sell it whole or whatever the case is. So, because most people think that once you buy these notes that you're stuck in it for the 20, 30 years or whatever the case is, right? Not necessarily that's the case. That's my understanding of my research, that you can actually get a person who may want to buy partial of it, or they want to buy the whole deal or whatever the case is. So you don't have to be locked in for all that at the time. But I would say the best place to be is where the bank is at, right? The banks are in that position for a reason. They know they're gonna make money over time, especially if it's a performing loan, right? But as we learned a little bit, there's this thing called non-performing loan too, but which can be a great thing to invest in as well, because you can hopefully get that turned around. So yeah, this is interesting. This is really interesting. All right. Here's the next one here. So what is a non-performing versus a performing note, right? What is non-performing? I think I kind of just touched on it a little bit. Anyone of you guys want to jump on that? What's a non-performing note? Right? So I jump on it. I jump on it.
Okay.
So a non-performing is basically it's a note that maybe a bank holds where the person is not paying their mortgage, right? They may be behind 2, 3, 4, 5 months, or maybe a year, whatever the case is, right? So it's non-performing. So the bank is not making any money off this loan. So a lot of times the banks are willing to sell these at a discount just to get it off their books, right? So performing loan is just the opposite of that. It's somebody who's paying it every single month. So of course, if they want to sell it, they're not going to sell it at a deep discount normally, right? They want to sell it at the highest amount possible. Am I saying that correct?
Yeah, absolutely. And there's a lot of models that either target non-performing or performing loans. There's another category that's called reperforming loans, which is when the current note holder has a non-performing and they get them to a point where that borrower is now back on track, and so they are
Yeah.
reperforming. And so there's kind of three things there as far as what type of loans. And obviously the better loans, the performing loans, are going to demand a higher price than somebody that's a non-performing loan. And so one of the things we try and do when we buy non-performing loans, there's really three outcomes that can come on that. Okay. And obviously the outcome that we all want to happen is to find a way to keep that borrower in the house, try and find if there's a mitigation type of situation that we can work up some sort of adjustment, a modification or whatever to keep them in the house. The unfortunate part of that only works about 30 to 35% of the time. The other option is what's called a deed in lieu of foreclosure. So if that borrower, we've come to the conclusion that particular borrower is unable to come up with a way to make the payment, bring the loan current, and you're kind of a situation that, you're going to take the house back, you oftentimes can go through a deed in lieu of foreclosure, which basically says they're just going to deed that property over to you without going through the whole foreclosure process. And that happens about 30 to 35% of that time. And sometimes it can happen because there are underlying liens, second mortgage, or something like that that don't get wiped out. You assume those if you accept a deed in lieu of foreclosure. And then, of course, the third and the last choice is to actually go through a full foreclosure where the borrower ends up losing the house, the bank takes it back, and then any subordinate liens get completely wiped out. And I know that there are people out there that like to buy non-performing loans, mortgage loans, because they will go ahead and foreclose, and then they will take that property and rehab it and put it back out on the market to resale, or they can oftentimes will keep it in their own portfolio as a rental house. Or what's real popular right now is selling that property to somebody else on a deed of trust and transferring the title. And so there's a lot of folks that do that seller financing. So where'd those guys go? So
they popped off here, but hopefully they pop back on here to say it.
Oh, they're okay. I see Lenny's got something to do. So
yeah. So that's what I thought about too, man. It's like, okay, so why would a person buy a non-performing loan? Because it sounds like it doesn't make sense, right? So you mean to tell me I'm gonna spend X amount of dollars on a loan on a house that a person who's living in it is not even making a mortgage payment on the property, right? So, like you said, it has to be some great situations in that property where maybe you get it at a deep discount. Maybe that person just ran a snag or whatever the case is. Now he's back on track or whatever. So you really need to see the story behind it.
Yeah, and that's all part of the due diligence process as you analyze, especially one of the important parts. Not only do you want to get a payment history of that particular borrower when you're going through the due diligence process, but you also want to get the call log, what's called the borrower call log, which looks at the conversations that loan servicer has had with that borrower to try and develop what that story is.
Okay, I've never heard of that before. So it's called a call log. That's interesting.
Yeah.
Okay.
So every time anybody calls into their mortgage company and they have a conversation with their customer service representative, that conversation gets logged in. They type it in with some keywords and things like that. So that's always something that can be reviewed and becomes a permanent part of the record.
Yeah, that makes sense. I was a mortgage broker for some years. And I remember seeing some things like that, right? I didn't
Yeah.
understand what it was about, but
Yeah.
now I'm on the other side of this thing, so that all makes sense. So yeah, man, and that it's just like anything you do, especially with real estate. You need to understand the situation. The person who knows more probably get the better deal, right? Should be more comfortable moving forward as long as you know the situation. So you're
Yeah.
absolutely right.
Yeah, there is an education process in this because, as you've already talked about, I mean, it's different from wholesaling properties. It's different from owning rentals because you're now the bank. And what I jokingly like to say, I'm not the landlord, I'm the lien lord. And so I
Yeah,
don't get the calls at 2 o'clock in the morning when the toilet breaks because I don't own the property. I own the paper. And hopefully the owner of the house, is the owner of the house, and they're the ones that have to deal with the broken toilet. So looks like we say, no
yeah,
toilets, no termites, no tenants.
absolutely, absolutely. So here's the next one, right? So the question is, how to find a note seller, right? Or somebody who's in need of selling that note, their note or whatever the case is. I know, like with wholesaling, right? You want to talk to that person to see what their situation is, and you tailor your offer to fit whatever their situation is. Is that kind of the same way when it comes to notes as well, or you just
Not
got to have
really.
like a
It's a
no?
little
Okay,
different. Yeah, it's a little different because it's all relationship building. You have to have relationships with like the banks that you've talked about. I deal
gotcha.
with several different hedge funds that work directly with the bank, and the hedge funds will purchase a large block of loans and then parcel those out so I can buy five, six, eight, or 10 at a time. And so having relationships with banks, savings and loans, if those exist anymore, credit unions, hedge funds, and then there's a couple different what's called an exchange on the marketplace. There's certain exchanges where you can go in and purchase notes on a one-off basis, where if I want to sell one note, I can sell my note on an exchange, and then
Yeah,
somebody out there will look at it and say, this seems to fit my profile, my model, and then we'll entertain a negotiation standpoint right through that exchange. So there's a number of different ways to acquire notes if you're buying that type of note. Now, the other thing we touched on a little bit, which is not exactly in my model, is buying seller finance notes, where you have a seller who sells his house to somebody else. Maybe they can't get a traditional mortgage, so that seller decides to sell it to them, carry the paper, and then that note is marketable. It is a commodity, and all those notes are shown. Since the mortgage or the deed of trust is recorded, if you have a relationship with a local title insurance company, and you can ask that title insurance representative to produce a farm of recently recorded seller financed notes or seller finance mortgages, they can give you a list, and then you could market to those sellers and buy the note directly from a seller. So that's another aspect, another way to do that. You can do a little bit locally. So if you wanted to do a 25-mile radius around your office, you would go to your title company and say, can you look at any sort of recently recorded or whatever date you want, whether it's 2 years or whatever, of privately financed seller finance mortgage notes, whether they be a first mortgage or a second mortgage, and have them do a farm list for you. And then you can set up a marketing campaign to those folks because, you know, everybody would like their cash right now, and they're willing maybe to take a little discount, due to
yeah,
the velocity of capital, to buy it now for a discount, whether rather than wait, for the next 10 to 15 years for that loan to pay off.
yeah. That's so true,
Yeah.
man. That's interesting. That's interesting. So so we have another one here. So here's a question. How to sell a mortgage note? I guess it's kind of the same, right? I mean, you got people who are out there who are in, let's say, REI meetup groups, right? Who may be doing the same thing as you're doing. You
Yep.
may be part of that group. They may have a group that you can post things on. And hey, man, I got this particular. Does this fit your criteria? Whatever the case is, and there it is. All right. so I guess it wouldn't be a problem if it's a great deal. Just like any real estate, you run across a great deal, it pretty much sells itself.
Yeah, in a lot of ways, that's exactly right. And so marketing those out is there's a number of different ways to do it. And a lot of it depends on if you're marketing to the type of buyer that are looking for that particular type of note. And so, I mentioned earlier in the broadcast, there's a difference between being in the or the note business versus being a note investor. And so if I'm a note investor, I may only have the capital to buy one or two at a time. And so those type of situations, as far as selling it out, if you have one to sell, you're going to look for those folks that want to buy one or two at a time, or one-offs as we call them. And that way I can put those loans in my own personal portfolio and have that borrower make the payments to me. Now, what I like to do is I like to buy notes in my self-directed IRA. And so all those particular notes pay me tax-free because the borrower's making payments right to my IRA. And so that's a passive income play that becomes non-taxable or maybe tax deferred, depending on the type of IRA. And so when somebody's looking at their overall, investment portfolio, I always like to say, make sure you're taking full use of your self-directed IRA to try and increase that balance as fast as you can, as high as you can, tax-free. So that's one thing to do. And mortgage notes are one of those consistent things. You get a good borrower, they're going to make their payment every night, just like clockwork.
Yep.
So
Now, I hope you guys understood what he just said. You buy it with your self-directed IRA, right? So the IRA is it's post-tax. So you're using it for real estate, like you just talked about. It can become a tax-free situation here. So, and we learned a couple of extra episodes ago that there's ways that you can roll your 401k possibly into a Roth IRA. So, and actually do this thing, man, without paying any taxes doing it, man. Let that thing continue to compound and make you money. That's your retirement. So if you're waiting on what's these different things the government's supposed to be offering us when we get older, man, it may not be here. Man, that is huge. I wish I'd have knew about this when I was younger. I wish I would have known when I was younger.
Well, the thing of it is, it's not too late. I mean, if you
It's not
have,
too late.
yeah,
It's
it's
not too
not too
late.
late for anybody on this phone call, because if you just have the right custodian for your IRA, they will allow you to purchase alternative investments in that. And ones I target are promissory notes secured by residential real estate. But you can also buy commercial properties. You can also buy apartment complexes. And I know some of the guys you have on as co-hosts from time to time like the multifamily type properties. You like the multifamily
Yeah,
type properties. So you can actually acquire a apartment complex in your IRA.
yep, absolutely.
And there's also lending opportunities out there too that will, your IRA provides the down payment. You can borrow money from a lender that's called a non-recourse lender.
Yep,
And you can
yep,
acquire, a higher price type apartment complex or whatever you want to in that for that fashion. Again, purchase something that creates an income stream that you can use when you're actually into that retirement.
yeah. And most people would probably think that this would, to buy mortgage notes, it's going to cost you a whole lot of money. But you don't have to. And there's a lot of situations you don't have to have $100,000, right? It depends on what you're looking at and what kind of deal you find, man. It could be 10 grand to get you started. You see something in the area, maybe you put 10 grand on it, buy it or whatever the case is, maybe put a few bucks into it or whatever. And you never know, man, that property value may rise, and then there you go. You sell it and put it right back in your Roth IRA and look for something a little bigger or something a little nicer. Before you know it, your pile is going higher and higher, and you got plenty of money to retire on. So yeah, this is a great thing.
Well, let me
This
give
is
you
a
a little
great thing.
case story if I can. Okay, I'll tell you about the first note
Okay.
I bought. Okay, it was in an IRA. It was a non-performing loan that was in a place called Klamath Falls, Oregon. Okay, which is down in the central part of this southern part of the state of Oregon. It was the loan was originated in like 2006, and this gal from California had bought the property. She brought it as a second home, but she never visited the property, and it immediately went south. It went into severely delinquent. I think it was 3 or 4 years delinquent when I finally bought the note. I bought the note for $12,500. Okay, spent a little money because I wanted to board it up and make sure that there were no, transients in it or any sort of homeless people doing it. And so I tried to contact the lady to do what's called a deed in lieu of foreclosure, because I didn't want to go through a full-fledged foreclosure. So I always like to offer, would you do a deed in lieu? And so somehow I found a guy who was able to track her down in Southern California. And I told her, because of being a non-owner occupied or a second home, there was a way that I could sue for what's called a deficiency judgment. So if I sold it at auction for $50,000, but she owed me $100,000, I could sue her for that deficiency of $50,000. So what I offered to her is, if you give me a deed in lieu of foreclosure, I will waive my right to sue for the deficiency judgment. And so she did. She signed the property over to me, and that was on, like, what was it, May 7th of one year. I listed it with a realtor on May 5th and sold it by May 12th. By the end of May, I had it sold. I sold it for $25,000. I own the property. I bought the note, held the note for about 8 months, and bought it for $12,000, sold it for $25,000, and it was 103% return into my IRA on that transaction. I was hooked. I was hooked.
Tax free.
And so the
There it
purpose of
is.
saying all that, exactly what you talked about, Jay, is you don't need a lot of capital in most situations. In a lot of situations, to purchase a mortgage note. Another opportunity is to purchase what you've talked about or said a couple times. It's what's called a partial. And somebody has a note out there that they own, and you want to buy the first, say, 60 months of that loan. And so you could buy a partial on that loan and get all the payments from that particular loan on a performing loan for 60 months. And then it reverts back to that original owner. So that's one way you can get in, by just buying a certain number of months right from the beginning. So whether that's 3 years or 5 years or whatever. So buying a partial is another good way for people to get on using their IRA or even with their other capital.
So let me make sure we get this right. So a person can purchase a partial of your note,
Correct.
And you can do it for a length of time.
Correct.
You can say, okay, I'm buying a partial of your note, but I want to buy it for 3 years.
Correct.
So at the end of them 3 years, it reverts back to you, the whole deal. And what he makes, it goes back in his IRA or however he decide to pay for it. I didn't know that part. That's phenomenal.
That is phenomenal.
That's phenomenal.
It's
right
a great way for people to get into notes by just buying the first 3 to 5 years of the payments. You're buying a payment stream for 5 years.
Wow. And again, guys, we want to be on this side of this type of deal where the banks normally will be at. The banks are in this in business to make money. So now we can move the banks out in this situation. We become the bank. That means we get that extra money they're getting now, right? Every single month. Now it may be a drip, so to speak, but if you got a Roth IRA and got a little bit of cash in it, you don't care if it's a drip for 3 years, still going tax free back into your Roth IRA. So why? Well, it doesn't matter, right? So man, that is huge. That is huge. And whoo, Jarrell, you hear that, man?
Yeah, I kind of came in on the end of it. I'm sorry about that, guys. Like
Wow.
I had a call from a lawyer trying to get out the office out in Cali, and I had to talk to him. So,
not a problem.
Yeah.
We're busy people, bro. We get it.
Yeah, definitely. I caught the end of that. Basically, he was speaking about being able to buy a partial of the note. That is something that I'm not really very well versed in buying notes myself, even though I help in facilitating the loan of a note, but how it gets sold on an aftermarket and how it's trickled down and split up. That's something I'm here to get a wealth of knowledge from. I know Cody definitely hit some gems on that note.
Well, Jarrell, kind of what I think, if I understand what you do, is you originate hard money loans. And so a hard money lender is funding those loans.
Yes.
And so that hard money lender could say, I need to recapitalize quickly, so I need to sell that hard money loan.
And they do.
And they do. And so in essence, you're kind of one of the guys that starts that whole process by originating that hard money
The
loan.
original loan, yes.
And so one of the things you might think about, since you understand the hard money loan business, is have some form of agreement with your hard money lenders that you get a right of first refusal to buy that loan if they want to sell it. So you originate it for them, they fund it, it's their loan. Now, for a reason, they say, I need to sell this loan, that they have come to you first for you.
Gotcha.
You know, obviously you have to have the capital for that, but
Yes.
but that's a way for you to get on these hard money loans because that's what you understand. And so I think that's a second stream of income for you.
Yeah, I never really thought about that, having the right of refusal on
Yeah,
the,
yeah.
because I know they sell them. It's 50% of the lenders sell, they don't keep it on their books longer than 30 days.
Yeah. And then you know what the quality of that loan when you originate it. So if they come back and you say, I want to sell this one to you, well, you know, yeah, this was a good loan I made, or no, this one here
Yeah,
was kind of shaky. I don't want this
yeah,
one. So you
yeah.
so you've got, I mean, Jarrell, you are set up perfectly for building your own note portfolio.
Wow. Okay.
Wow.
Okay. Thanks, man.
The only thing is, as
Appreciate
I
it.
would say, is that in the state of Georgia require, well, do you have your NMLS license?
No, I broker through lenders that have their MLS
Yeah.
license,
Yeah.
but in Georgia,
So
like California, you can't.
yeah, yeah. So in Georgia requires licenses as well to buy notes. So that might be
Yeah,
a step you'd have to go through
yeah,
in order to do that. But you know, they might allow up to like 4 per year without requiring a license. That'd be something you'd want to check with your attorney on. But you know, from the structure, is what I understand that you do, you're well positioned to create a second income stream.
definitely. I throw that in the tool bag. I got you. I
All
got you.
right.
Yeah.
All
I
right.
And
appreciate
now, a quick disclaimer. So we're not attorneys. Contact your attorney, your CPAs, and all that good stuff. This is for entertainment purposes only.
Yeah,
Right? So, all
definitely.
right. Okay, man, that's huge, man. So I got a quick question for you. So, Mr. Cody, I've seen this right here. It says 4 ways to recapitalize. So, and they ran off about 4 different things. He said one way to do it is to sell the property. The next one it says refinance the property, take cash out. Another one says sell partial note. We talked about that a little bit. And it says, what's the last one there? Borrow against the note. So how do you borrow against the note though? So I guess if you have a note and the asset is there, you can pretty much go anywhere and borrow against the note there, right? It's backed by its actual real estate.
Yeah, I'm trying to remember what the term of that is. That's a collateralization of your note, and so you own the note, or you're about to buy a note. This is what I've done a couple times, and it's worked out real well. Is that I'm about to buy a note, and so in order for me to fund that note purchase, I'm going to take out a loan from one of my other investors and use that money to buy the note. And then I promise a certain return back to that lender. It's just a mortgage. It's just a note against that note that I bought. So it's a promissory note that I've collateralized by the mortgage I'm buying. And so a certain part of that payment is going to go to them, and then I get to keep the overage. Typically, what I'll do is I'll borrow on an interest only loan, and the borrow from that lender, from that investor, to collateralize. I'm trying to make sure I don't get this confusing, but so I'm going to borrow money from another lender to fund this note purchase. That loan I'm borrowing, I want to be interest only to keep my payments lower, and then the note that I'm buying has principal and interest payments on it, so the payments coming in are greater than the payment I have to make on that collateralized note. And so I have an income stream
Gotcha.
there over and above. And so there's actually kind of 4 different kind of profit models in that collateralization type situations, because you don't have to make a payment to that first lender that I'm borrowing from for 30 days after you bought the note. So you get one payment from the borrower. Okay. Then you get the spread between what your payment is that you borrowed at versus the spread from what the payment that you're getting in. Okay. And then I usually borrow a little bit more than I'm paying for. That way I put a little money in my pocket so I can, go to Atlanta and
Yeah.
see Terrell, And then the fourth thing is when this loan matures, and I pay off that underlying mortgage, I usually sell the note for a little bit more than what I borrowed money from. So I get another little profit model on that. So there's 4 different ways to make money, 4 profit points on that particular structure. So there's, one of the things that Lenny said before he got away in his introduction, he talked about creative financing. This is creative financing. This one's
Yes.
so fun.
You're creating money.
Yeah,
Yes.
exactly.
Yes.
So,
Yeah. So basically, that interest only loan is not paying down. Every payment you pay is not paying down the note that you
correct.
borrowed.
The principal.
Right.
Correct.
Yeah.
And
But
the
it's small
principal.
enough.
Oh, okay.
Go ahead. I'm sorry, Jay. Go ahead.
Why not just get a small? Is any option to get a lesser interest loan from that first lender?
You could.
That's not interest only.
It's all negotiable.
It's all negotiable. Yeah, but I guess the basically the beef in it for that investor is the interest only aspect.
Yeah,
take that out, and it's not as advantageous anymore.
And I would venture to say that in some of the hard money loans that you originate, that those are interest only loans as well.
All of them except for 30-year loans. Of course.
Exactly. Yeah.
Any short term 1 year loan is going to be interest only.
So you might ask some of your better hard money loans if they ever would they borrow. Could you borrow money from them collateralized by a note? And then I'd walk, I'd be more than happy to walk you through all the mechanics of that. So,
Excellent. So we talked a little bit about non-performing loans, and so I was doing some little research on this. So we were saying that a lot of times, man, of course, you get them at a deeper discount of a non-performing versus performing, right? So let's say you purchase a non-performing loan. You want to try to have maybe a 12-month season in there where that person is making payments consecutively like 12 months. So why is that important? Why do you guys think that's important?
You said that to make sure I understand the question correctly. You're saying that why is it important that you've seen 12-month seasoning on a note?
Yeah. So like non-performing loans, basically, right? You get them at a deep discount versus a performing loan. So let's say, and a lot of times, some people's strategy is to only get non-performing loans because they have different ways to maybe raise, make some money off of it, whatever the case is. So what you want to try to do is get that person who actually who's living in this property to make their payment consecutively at least 12 months. Because after 12 months, they can go back and revisit this thing. Now it's actually a performing asset now. It's worth a lot more money in that situation.
Yeah, I've heard. I've never gambled into buying non-performing anything. I mean, I like to see occupancy in anything that any of my clients are bringing to the table. Do you have any thoughts on this, Cody?
I do. Because I buy non-performing notes all the time. And because as Jay said, you can get those at pretty significant discounts. You can get them at the lower of, say, 60% of unpaid principal balance or current market value. So we don't use after repair value in the note business. We look at current value. And my goal is to try and buy that at 50 to 60, maybe 65% of whatever the lower of those are. And so oftentimes it's a little tricky when the amount of the loan is higher than what the value of the house is, which happened quite a bit in 2009, 2010, 2011, when houses were underwater or upside down. So I'm buying the note at 50 to 60% of whatever the unpaid principal balance is or whatever the value is. And so once I own that note, what I want to do is I want to have a conversation with the borrower, with the homeowner on that, and find out, what's going on. Why are you guys non-performing? What's going on in your life, to see if there's a way we can do a workout for them. And so if there was a workout that says, well, my husband got sick, he wasn't able to work, he's working now, I'm working now, our income is much better than it was. So what we'll try and do is we'll try and find a workout where we can get them back on track and come up with kind of a payment agreement. Like, if you can make your payments to me for the next 6 months at this amount, then I'll roll it into a modification and we'll formally modify the terms of your note to make it advantageous for you. And you get the opportunity to do that because you're buying that note at a discount. It gives you all that room, that spread, that you can offer these kind of options, modification options, to these borrowers. So once you've gone through that 6 month payment agreement, then another 6 months worth of an actual formal modification, then you've got that 12-month seasoning that Jay was talking about. And now the value of that note is increased from what you have it. And so that is called a reperforming note. You've taken that non-performer, it is now reperforming. We've got a 12-month history of them making their payment as agreed, and now it becomes a marketable product that you can sell for 70, 75, sometimes 80% of value, or even more, depending on the strength of the file overall. So that's another profit model for you. Buy low, get that borrower to making their payments. We call it rehabbing the borrower. And so we get them back in, and
like
they're
that.
making their payments, and now we have a reperforming loan that we can sell back out. So yeah, so the 12-month seasoning comes into play. Its importance because it now shows that new note purchaser that your borrower's back on track. They have a consistent payment record, and their money is protected if they're going to buy at the price that I want to sell it at.
Yeah, because banks are not here to swing a hammer. Right. So once we understand the situation, maybe what needs to be done is probably whatever the case is, we have options, right? If they're not performing and they're behind a couple of months, we can foreclose on them in that situation. Or, just like Cody says, whatever, you see that before they was making payments on time, and now you see now both of them got a job and they both are doing what they need to do. It's a tons of reason why you would do a non-performing loan. I can see that. That probably, if I was doing those, that's what I'd be going after. That's where the meat is at.
With hard money lenders, they want to see occupancy. This is my realm. Yeah, they want to see some type of. Now, in a bridge loan, they don't care about occupancy if it's performing or not. But any 30-year purchase or refinance, they would like to see a lease in place performing. It's just different strokes for different industries,
different models.
They're selling that note quickly, so it must be performing. It's just different strokes.
Yeah, one of the things that I think that your audience will enjoy is that when we're buying notes at our level, the investor level or small fund level, like I play in, is we have a better opportunity to help that homeowner. Okay, where the banks and all the other stuff, it's just another number. You're not paying. I'm either going to foreclose or sell this non-performing asset off. But at my level, we can do some things with our homeowners, and we can work some magic that they wouldn't be able to get if they if the note was still owned by a bank. So here, 2 weeks ago, I get a call from one of my borrowers. He owns a little property in Mississippi, and he says, "Hey, I need some help." He says, my father passed away and I need to go up to New York for the funeral. And, I don't have enough money to make the house payment for May. What can I do? What can you do for me? So what we did is I said, well, okay, skip the May house payment. We'll take that May house payment and divide it by 3, and you can make that up in the June, July, and August payment. After the end of that, he's back on track. Now, are you going to have a regular mortgage loan servicer or a regular bank do any of that? No, the guy just lost his father. He was already kind of having a situation. So let's be empathetic. Let's help him with that. Let's just forgive. It's not a forgiveness, but we're going to allow him to skip his May payment because he's going to be able to make it up in the next 3 payments. So we just divided it by 3 and added it to payments. And boom, he was happy with that. And now he can go up and pay his proper respects for his father.
Yeah, without that over his head, right? Yeah. So that's huge. The bank is basically gonna say, "Hey, man, well, there's nothing I can do because you're talking to a person who just got hired, right? Who can't talk to his manager or her manager, or the case is." So Yeah, no soul a lot of times. So, all right. So now, one of the things that I remember hearing Cody talk about, man, in this business, right? We talked about, this investment, right? It's truly passive, right? Is it 100% passive? Or we talk about 90% passive, 99% passive, or is it 100%
Okay. Now, I
passive?
know we're not attorneys and we don't play
No,
them on podcasts, but I'm going to give
no,
my
we do not.
attorney answer, and that is maybe. It depends.
Mhm.
So it depends based on the quality of the mortgage. Okay. And so if it's a performer that's been performing, month after month, month after month, that's pretty passive. And that's the ones I
Yeah,
kind of like to put in my IRA. So I don't have to have all those other expenses of dealing with, a non-performing or a low performing loan. So if they're just making their payments, it's pretty non-pass or pretty passive. You don't really have to do anything like that.
yeah,
If the borrower's having some payment issues or some struggles, or they forgot to renew their insurance, or their property taxes get behind, all those things can impact the quality and the security of your mortgage. Then you have to get a little bit more active. And so,
Mhm.
so it kind of depends again on what the quality of that underlying mortgage is that you bought. And that's
yeah,
if you're an investor. Okay, if you're actually investing in mortgage notes. Now, the other thing I like to talk about is the mortgage business. And Bridge City Factors, again, manages a note fund, and that note fund has raised capital from investors. We have used that capital to buy notes to put in our portfolio. For those investors, it is a purely passive play. All they do is fund me the money, and then I pay them back. We pay them a return on a quarterly basis, and all they do is go to the mailbox on the 15th of the month after the loan is after the third quarter, fourth quarter, first quarter is passed, and pick up their dividend check. And so that's a purely
mhm,
passive play on that. So that's the decision that people have to make. Do I have some capital? I want to just invest and let somebody else manage my money for me, which, I'll do that. Or do I want to use my own money to actually purchase the loan, own it myself, and deal with all the other activity that's involved in owning a mortgage note? So there's a couple different ways to make that active versus passive play.
passive.
Mhm.
Yeah. So hope you guys heard that. We have a lot of people actually kind of watching it. Listen, this is an opportunity. I know Cody got some stuff that's coming up down the pipeline here pretty soon here. So you guys got his information. Definitely give him a call, look him up, see how you can get involved in what he got going on. But if you're working a 9 to 5 and you should be in real estate, some capacity, right? But you don't want to put in all the work maybe it takes to do certain things or whatever. Reach out to Cody. See how you can be passive and get that mailbox money that he's going to be issuing out. I definitely want to be involved in that,
To be
man.
passive,
Some mailbox money. Yes.
sir.
Yes, sir.
Yes, sir.
All right.
And then
So I have
head back to your hammock after you pick up the check.
yes, yeah. Absolutely. So I got another one here for you, right? So here's a good one, right? Who collects the funds? So if you're the note guy, where did the money go to? Who it goes to?
That's a great question, because I certainly don't want to have the money come to me from the borrower. Okay. Because there's a
Exactly.
so what I do is I work with licensed loan servicers, specialty servicers that work with investors like I am. So every
Yeah.
borrower makes a payment to a loan servicer, just like you guys may in your mortgage. You send your payment to a servicer. That servicer processes the payment and then remits the funds onto the investor of the loan. I'm the investor on the loan. I hire a service company to do all the paperwork and the payment application and track the reduction of the principal balance, make sure the insurance is paid, make sure the taxes are paid. And also the big deal is make sure they spit out all the tax documents, the year-end statements, the
Yeah.
1098s, and that sort of stuff. I don't want to do any of that. I want to be as passive as I can. So I'll spend 30 to 45 bucks a month by having that servicer do that for me. I mean, that's nickels on the grand scheme of thing. And so
Yes.
you don't have to actively self-service a loan. In fact, I've made a part of my model, my decision is I don't want to buy a loan that has been self-serviced because they don't know what they're doing. And with the Dodd-Frank legislation that's still in play and the
Yes. That's a huge
CFPB
deal.
that's still in play,
Yes.
they
Yep.
manage and require all the people that service loans. States require loan servicers to be licensed in their particular state. So I need to have somebody take that middle ground for me, collect the payments, and then remit the funds onto my fund. So
But something so small as when you take over the note, right? You start servicing it yourself. Did you send that hello letter, right?
exactly, great question.
or that goodbye letter? Like, that's
Yeah,
a big deal. That's
yeah,
a big deal. If you don't know about that, you can put yourself in a bad situation.
that's all
So I definitely agree
RESPA.
with you.
That's all
Yes,
RESPA.
sir.
Real
Yes,
Estate
sir.
Settlement
Yes,
Procedures Act. So yes, all that is RESPA, the
sir.
requirement. It's got to go out within a certain time frame of the acquisition of the
Certain time
transfer.
frame.
Yeah, and so
Yeah,
that's I let all those people. I have people that do that for me. So
yeah. The service company will take care of all that stuff for you.
yep,
So and there's a way that they know that actually everything's been taken care of as well. So it's serves for their benefit as well. So I think that's a great thing.
Have you heard of a
All
company
right.
called
So
Face Servicing?
yes, I have. Yes,
Okay, cool.
what is it called,
Face Servicing.
Jerome?
Face
FAY.
Servicing.
Okay.
It's a servicing company.
Okay.
Well, then there's
Okay.
you.
Now this next question, we kind of touched on this a little bit as well. So let's see if we can kind of dive in a little bit further, right? Do you need a debt collector's license in this situation? Right? To collect the debt in certain states, you gotta be licensed, right?
It
So
depends.
it
Yeah.
depends.
It
Okay.
it depends on the state. Okay. We talked about Georgia requiring a debt collector's license. Illinois does. All the West Coast states do require that license.
What
Actually,
about
you can
Texas?
go. Texas does not.
It does not. Okay.
Does not. Florida does not. Uh, the Carolinas do not. Mississippi does not. Alabama does not. I focus in Michigan, where you're from. Michigan does not require a debt collector's license. Indiana does not. Missouri does not. Kansas does not. So, and there's a way you can look at these by going into the NMLS, license lookup, and find out what states do and what states do not. And so, so it just, again, it depends. So, so I know a lot of folks that don't have licenses, which I don't have any licenses. So I'm very careful about the states that I select. I'll probably go for my NMLS license shortly, which will allow me to have available in certain states, but certain states still require that additional level of being a debt collector, even though you've sent it over to a loan servicing company because you are purchasing the debt. Certain states' laws, statutes require that you have the debt collector license yourself. So
Okay. Wow, that's a good one. Man.
this talks
Um,
about, and really what you're illustrating here, Jay, with your questions is there's some complexity to this. Okay. There's
yeah,
some
yeah,
complexity with this because you're doing with it kind of on a national basis for the most part, rather than your neighborhood. And so, a
yeah,
wholesaler knows the laws and things within their state and their neighborhood. But if you're going to buy notes, like I don't buy any notes in my state of Oregon or in the state of Washington or a state of California. I stay out of the West Coast. So most of
yeah.
my stuff is all east of the Mississippi for that matter, although I do some things in Missouri and Kansas and Wisconsin and things like that. So I guess I would say it's east of the Rocky Mountains, although I have
Yeah.
some in Nevada as well. So.
Yeah.
Nevada
Okay.
doesn't require
Nevada does not require a
Yeah,
license,
yeah,
but they are very, very sticklers
yeah,
in
they
the
are.
court system for foreclosures. So you have to have all your ducks in a row if you're going to foreclose in Nevada.
Wow.
Okay.
You also have to have a
So what
network
about?
of attorneys, and I don't know if that was what your question is, because the states that require a judicial foreclosure, you have to have a network of attorneys who are going to manage the foreclosure for you. So part of your analysis during the due diligence period is if I have to foreclose on this house and I have to assume a worst case situation, what are my attorney fees going to be that I'm going to have to pay out and still keep this being a profitable acquisition for me. So
Yeah.
I have income analyzers, I have deal analyzers that I look at to make sure I'm acquiring that property at the right cost. Otherwise, I'm going to have to come out of pocket for additional money to foreclose on, and I don't want to do that. So
Yeah.
So
All right. So I can hear somebody asking this question, right? All right. Do you need the LLC before you buy a note? Any notes, right? You need an LLC. I know you don't want to do these type of things right under your personal name, man. Right?
Yeah.
So yeah, I would say yes. Get you something set up that protects you in that situation.
I would answer that by saying you don't need one, but you should have one.
Have one.
Yeah. Because people nowadays, well, how do I say this in a couple different ways? Is that buying a note is not buying a piece of real estate, and it can be considered security. So if you're soliciting money to buy notes, that's considered a soliciting for a
Yeah.
security, and the SEC and the state,
Yeah.
Department of Finances get involved in that. So people do sue, you know, and so you want to make sure that you have that shield of protection against your personal stuff, and that's why an LLC is important. Remember, an LLC doesn't save you anything in paying taxes. What it does is provides you a shield against
A layer.
lawsuits.
A layer.
Yeah, exactly. Yeah, that shield, so you don't have, so your personal stuff is not at risk in the event of a lawsuit. In fact, what I've done is I have actually registered my fund and Bridge City Factors are two entities in the state of Wyoming, because the state of Wyoming does not require you to identify the personal owners of the LLC. So
Yeah.
it's hard to breach that when this attorney wants to find out who the owners are. They can't find it because I'm registered in Wyoming. Wyoming shields that for me. It masks it for me. So that's an additional a level of
Protection.
entity protection. Yeah. So
Yeah. Oh, okay.
Sort of like
Excellent. Excellent, man.
an incorporation. It masks the owners of the
absolutely.
incorporation. Yeah.
Yep. Very true.
So
That's
what
that's more
yeah.
widespread though, audience, rather than finding a state that does it for LLC, because LLCs does list articles typically in most states, but incorporations is a whole nother ball game where it doesn't list on public sites the owners of that corporation. Go ahead, Jay. I'm sorry.
So what about what kind of rate of return are we talking about when it comes to notes? Um, are we looking at what 5, 10%, 20, 30%? I know each deal is different, but kind of like a general number, roughly.
Well, kind of what I look for on performing notes is to try and calculate a way that I can get at least a 10 to 12 to 14% return. Okay. And
That's a good return.
the way you do that is by buying them at a discount. Okay.
Yeah.
If it's a reperforming loan, I want to get it about 16, 18% on a return. And if it's a non-performing note, I want at least a 24% ROI. And oftentimes, if you buy right and keep your expenses to a minimum, and it's very, very fast turnaround time, like Texas, you can sometimes get 35 to 45% return on those if you can buy them, foreclose, remarket those, sell them out very, very quickly to return your capital. And so a lot of it depends on how active you want to be. You've got your network set up, whether you're going to rehab them yourself before you sell them off, or whether you're going to sell them as is if you acquire them back through a foreclosure. And so it could be anywhere, and that's part of the calculation. What am I going to be happy with in a worst case scenario with the type of return for my capital? And do I have investors involved? What sort of expectation do they have as a return? So, but it can be very, very lucrative. So, I mean, one of the things I did is if your target in an IRA was like a 9% return, you would only need about 24 to 25 notes to pay you 15 grand a month. And so, 9% is a good target. for most situations. I think all of us would be happy with a 9% return in our IRA. And if I had the capital in order to buy, what did I say, 24, 26 notes? I'm going to pay myself $15,000 a month in income that could be totally tax-free.
That's pretty cool. That's pretty cool. So one thing I learned about this right here, man, that from my understanding, right? So I've been in this business for a while now. I've been on the mortgage side, I've been on the wholesaler side, the commercial side. So and it's crowded in those areas, right? Would you say in this particular arena, the mortgage notes are probably less competition? I know you
Yes.
probably. I know you probably. You see, you're around people who are doing that, right? So you see a
Right.
lot more than the average person sees. So coming in the game, people are not coming in the game buying mortgage notes. They're doing other stuff first, but it's less competition, man. It really is. It
Yeah.
really
If
is.
With banks, small branch banks.
Well, small banks, if they have a portfolio of loans that they need to recapitalize every now and then, I mean, that is obviously, if you could get into that and be a consistent buyer from them, then they're not going to shop the loans to other buyers. But there is less competition in the note market because it's kind of interesting. If I go to like a dinner party or I go to some sort of social engagement and people ask what I do and I tell them, I buy promissory notes secured by real estate, they have no idea what I'm talking about.
Yeah. Yes.
No idea
Yes.
whatsoever.
Yes. So
If I go up
true.
and say if I go up and say I've got 10 rentals, they understand perfectly what I'm doing. Or they
Yeah.
say I'm a rehabber, I rehab property, they know exactly what I do. And so it's a little unique. And so the competition is growing because more and more people are finding out about it. But unless they're properly trained and have an idea what's going on, they're going to fade out. Because I know a lot of people that got all excited about this, tried to put their feet into it, put their feet in the fire, and find out it's a little bit more complicated than they have an understanding, so they fade out of it. There's a lot of that goes on, but the competition is less, especially the higher up in the food chain you go, which basically means that the closer I can get to the actual owner of that note before it's been sold 2 or 3 or 4 times, uh, the less competition I have, because most folks out there don't have a huge amount of capital out there, and that's why I come bring them to the marketplace, a fund where I can raise capital from investors who want to invest passively and raise millions of dollars, which I can buy in larger quantities, versus somebody that maybe has a 401k that they rolled over and have $150,000 in that. That kind of limits how much they can acquire. And so that's, the higher up the food chain you go from an acquisition, and so my marketing is completely different as well. As most folks that are dealing with acquiring real estate, they're marketing to sellers of that real estate, whether it be an out of state landlord or, whatever that might be. I don't deal with those people. I deal with whoever owns the notes, and I market to those folks, or I market to folks who have capital, who
Yeah.
have money that they want to invest. And that's my two marketing thing. It's more of a business to business type of approach versus a business to consumer type of approach. And so it's a little bit different from that type of strategy as well.
Yeah. Would you say a wholesaler, right, would have okay, some of the techniques that we use to find the owners of some of these properties, right? When we find some of the owners of these properties, we realize that they're in a tight situation. Would you say if a person was to transition into do mortgage notes, that could be a plus? Because we realize that this person's behind on his mortgage note, behind on his mortgage payments or whatever the case is, and we obviously have the name of the company or the bank that is got the loan through. But I guess we still have to get to the person who makes the decision on the bank side, I guess, right? So we have to
Uh-huh.
acquire skills for that side. So I think I answered my own question.
Well,
so
I have never been made aware of somebody who's looking to acquire a property that ends up buying the note. So that is generally not an avenue, because most of the sellers of a note don't, unless they're a privately owned note, don't want to sell one at a time. Most of the better quality loans, sell in large pools, and that's where and it has nothing to do with the homeowner. You don't want to deal with the homeowner in order to acquire a note. You want to keep them completely out of it. They're not involved whatsoever. And so, if you have a property you want to wholesale, you're working with a seller, and you want to wholesale it, they're in distress or whatever. I've never been aware of any situation where that particular wholesaler is able to buy that note from that lender. So
Okay. All right. So we have another one here. So can all title companies close mortgage notes? You go to a title company to acquire these properties?
well, you're not acquiring new title insurance. So, but you do close either through attorneys or escrows. And so they can do that.
Okay.
Typically, most of the ones I don't, because I have due diligence. I know my sellers. And so I know the quality of what it is. But if there's underlying liens that need to be paid off or a number of different things, then it's always better to work through an attorney or an escrow company to make sure that the underlying liens do get paid off. So it just kind of depends on the structure. You can use an escrow or an escrow attorney to do that, uh, or but most of the time that isn't necessary.
Yeah. Okay. So I was looking this up here, so I've lost my place in there. But have you ever heard of FPI insurance?
Yes. Yes.
Yeah, that's mandatory. We would say, right? Because if for a person that's doing notes, you think that's mandatory?
Well, it's not always mandatory. It stands for force place insurance or lender
Yeah.
placed insurance. And part of the requirements that are spelled out in the note in the deed of trust are that homeowner must cover the property with fire and extended coverage or a homeowner's policy, at least for the amount of the mortgage that's outstanding. And so if we determine that insurance is not covered, that house is not covered, then we issue that policy through one of our vendor insurance companies, and that is called FPI or forced place insurance. So that happens on loans that we are aware of or property that we know of that doesn't already have an insurance policy on it by that owner. So it's not always mandatory. Some lenders like to do it just in case, but I don't think it's enforceable to have double insurance on a property. So that
Yeah, I don't
might
think
be a
so.
question. Yeah.
Yeah. Because wow, yeah, it's not no. But here's the deal. So if a person is behind on their mortgage payment, chances are they're gonna be behind on their insurance and all that good stuff as well,
Mm-hmm.
right? So if you acquire a property, they maybe 5-6 months behind, or whatever the case is, you may want to inquire about that insurance or get that FPI
Sure. Yeah.
insurance in place.
Yeah.
And then when they can show proof that he actually has it, then you can take it off,
Yeah.
or whatever the case is, right?
Correct. Yeah.
That's important because you don't want to acquire that note and the house get burned up,
Yeah.
and all of a sudden you out of your money. That can
Correct.
be a devastating.
It can
That
be.
can be
Yeah.
very
Yeah.
devastating.
Yeah.
Yeah.
Yeah. And property taxes as well. When I go through due diligence, there's three main things I look for. Okay. And that's title, to make sure the title's clear, or I have the complete documentation of all the title that's transferred, which is reviewing that allonge or endorsement to the note, and then the assignment of mortgage that it assigns it over my company. So title, taxes. I want to make sure that the taxes are current on that house. And if they're not current on that house, then I will reduce my offer to buy that note at the same amount
Pay
that
the
the
taxes
taxes
off.
are delinquent. Uh, and the third thing is value. So you have to make sure as best as you can, with the understanding that you're not going to get an appraiser to go inside that house to see what the interior looks like. And that's where the BPO comes in, the broker's price opinion, along with any other models that I can. I think I have 10 or 11 models that I look at to try and determine value, as well as having actually a broker's price opinion. So those three things, taxes, title, and value, are the three most important things when determining the value of that particular note that you're about to require.
Absolutely. Listen, this has been action packed. This has been action packed. I got one more for you. One more for
Okay.
you. So So I've seen this thing online platform where it's telling you where we can find these kind of properties from. Are you familiar with paper stack
Yes, I am. That
or
is one of those
online platform?
exchanges that I referred about. Yeah, yeah, and they're
Okay.
growing. They're popular. I bought notes from PaperStack. In fact, I'm one of the guys that runs PaperStack is doing an interview of me here in the next couple days. So while we're at
Ah man, that's
while we're at
huge.
the conference, yeah. So
Okay. So going through paper stack, you're able to do one offs. You don't have to buy
yep,
a
correct.
group of them or something. Okay.
Yep.
Okay.
Yeah, and
Excellent.
there's sellers on there
Excellent.
that will sell partials too. So, you should go in and sign up for PaperStack. It's actually one word with no K at the end of it. And that
Okay.
way you can sign up for PaperStack and you can see what they have to offer there. And so if you want to buy a partial because maybe you're limited and you want to give a try on something, you can look for those there. And they will handle the whole transaction. They will handle the exchange of money. They will handle the documents. There's a purchase and sale agreement that's involved there. Because you're still buying an asset. So they handle the whole things. They handle the escrow. They get a little fee for what they do. But oftentimes, there's two things I would say. One is they're going to manage the process for you if you're a newbie. But the second thing is it's kind of the bottom of the food chain, meaning that you're going to probably pay a little bit more for that purchase because they're selling one off. So it's like anything. If you can buy a quantity of something, that's why the prices at Costco or Sam's Club are lower because you're buying bigger quantities of it versus what you're getting over at Safeway or Kroger's.
That's true. That's true. Listen, man. Hey, Cody, Mr. Cody, you knocked it out of the park again, man. As you guys know, and you see, man, this is what Cody does. Definitely reach out to him. Definitely reach out to him.
Yeah, yeah,
See how you guys work. Tell him reach you on this stuff, Cody. Uh,
yeah.
tell,
So are
tell
you,
him how to
you
reach you.
well, the easiest way is the email that I have listed there is Cody@bridgecityfactors.com. Just shoot me a quick email and say, I have this scenario. I want to ask more about this or whatever. And, I love talking with people and kind of give them idea, come with some concrete questions and expect, not an extended conversation because I am fairly busy, but, I can give you some direction on maybe what the next step is or maybe some scenario questions as well. And also, if you're an
Absolutely.
accredited investor and have some capital you want to invest, I'd really like to talk to you.
Absolutely. Man, as you guys can see, he's a wealth of knowledge, man. We really appreciate it, man. So buying mortgage notes, man, I've learned a lot. By
Awesome.
doing the study that I did, man, and the stuff that you broke down to, you really kind of you simplified it for us.
Good.
And it's good to know that here in Texas and in my hometown, Michigan, we need to work together because I know a lot of places in Michigan we need to work together on that, and
Sure.
especially in Texas
Yeah.
as well. I
I
need to know
like
how we can
Michigan. I
work
like
together on some stuff.
Texas. Yeah.
Yeah,
So,
absolutely. Absolutely. It's gonna like us both too, man. It's time for us to make some money together, brother.
I love it.
Yes, sir. Yes, sir. So listen, man. Every 2 weeks, in 2 weeks from today on Wednesday, I get this confused a lot of time. Hop
Yeah.
on, man. If you guys want to be a part of this, definitely reach out to me. Um, we want to pick a particular topic about, this week I said notes. I'm like, man, okay, so let me learn about what you do because I know we talked the other day about a particular deal I was trying to get done, and so you go through what you got to do. I'm like, okay, we need to do some more research on that. So now when I run across something like that, I know exactly who can get that thing done. So I really appreciate you.
All
I really
right. Thank you.
appreciate you.
Thank you for asking me
And,
to be
and if
part
you
of this.
guys, no, hey man, I appreciate you, man. If you guys learned anything, give us a thumbs up. If you didn't learn anything, give us a thumbs down. Right? It don't matter. Share it, like it, all that good stuff, and hit that notification, man. And we'll see you guys in 2 weeks. Hey man, I appreciate you, Mr. Cody.
All right. Thank you,
You have
Jay.
a great one.
Appreciate
Thank you
you.
for your time.
All
All right,
right.
have a
You're
great rest
welcome.
of your day. Peace.
Uh-huh. Bye-bye.